I can almost guarantee that somebody has told you it is a terrible time to start investing in property. It might be your mate at the pub. It's probably been the news. Or it might even be your own inner thoughts and head saying, I want to start in property, but it's just not the right time, which, to be honest, I've heard a million times. Here's the thing. I've been investing in property for 10 years. I've done over £10 million worth of deals in HMOs, new builds, buy-to-lets, deal sourcing. And I look at this market now, and it's certainly not what is being portrayed in the general public, mainstream media, or on social media. If you're sitting on savings and you're wanting to get started in property, stay with me here because this video is definitely for you. So here's the big headline. 93,000 landlords left the UK property market in 2025. They sold up, they got rid of their stock, and they've moved out of the UK property market. That's a lot of people. And the way that the headlines have been in the mainstream media is that that is an absolute disaster and the worst thing that's ever happened. But here's a question that no one's asking. When a landlord sells, who buys? So someone has to. And a lot of landlords are selling up. They've had it good. A lot of older landlords have had it good for a long period of time. They bought in the 90s. Property was less legislation, you could get mortgages a lot easier, money was cheaper, relatively easier, cheaper, and they had it good. And then now more legislation, tax changes that didn't help them, and tax changes can help us now because you buy the right way more admin, they want out fast. They've not managed their properties well either, so the tenants are under renting and not paying the right amount of rent that they should do. So now we've got a wave of properties hitting the market, landlords that don't want to do any work and are relatively lazy in that respect or tired, and they're hitting the market fast, and we need buyers. So who buys those properties? Most of these properties are set up as rentals in good areas, and they are now getting sold by motivated sellers, and it is one of the better buying environments for a new investor or for an investor that is set up and prepared to buy in this market. And for lots of different reasons, but on this video we're going to focus on one, because landlords are selling and have sold, and some have sold to first-time buyers and some have sold to, owner-occupiers that don't necessarily want to rent their properties out. We have a massive supply and demand issue. So we've had this supply and demand issue for a while. We aren't building enough houses. The government promises to build millions each year, or 300,000, and they get nowhere near each time. I think this government has said, Labour, that they're going to build 1.5 million homes in 5 years. They're not going to get anywhere near that. Even if they remove the red tape and let you build houses, there's not enough labour to build those labourers in builders and what have you to even build those homes in the first place. So we now don't have enough houses. We have high net migration. We are living longer. So there aren't enough houses to support the people that live here. Not everybody wants to buy. Some people do want to rent for different circumstances. They might be getting divorced. They might have moved area. They might have moved jobs. They might have changed their circumstance. So they might want to rent as an interim property, not necessarily as they're changing their life. Some people don't want to buy, they don't want to get a mortgage. So tenant demand is high, supply is low, rents are rising slightly above, inflation. They have to stop at some point because of, affordability effectively. But it is a good time to buy a rental property. If we buy it in the right area, we get the right tenant in, we can make a good net margin, it is a good time to buy. So we have more choice, we've got some good negotiating power, we've got properties that we want to buy in good areas. So far it sounds like it's not that bad an option to start buying. So the biggest problem I find when speaking to anybody in property is fear. And I suppose as humans, as we get older, ironically we get more fearful when we should actually be less fearful because we have more knowledge than we did when we were younger, but that's a different point. The fear isn't completely made up. There are reasons that sensible, clever and intelligent landlords are selling up. It's not like buy property at all cost, everything's green and rosy and it's all fantastic. But there are a few issues and we can address them, right? So the first one is the tax issue. Section 24 came in, or started to be brought in about 10 years ago by George Osborne and has now been fully implemented. So if you own a property in your own name, you get taxed on 100% of the income, not the profit, the income, which is crazy. There's not another business where you get taxed on the whole income. So that means that owning property in your own name becomes nearly, impossible to do, or not impossible, but certainly, not profitable to do. Like it almost costs you money at times. And back in the day when people were buying properties, they were told to buy them in their own name. So it's sort of gone against what a lot of people have done. Landlords pre-2008 really have done, and they've now got a load of property in their own name that they don't want, that's becoming inefficient to own. So that's a problem for them. and they can't sell it to themselves without getting hit by a lot of tax anyway. So they might say, well, I've made my money, I've done all right, I don't want the property anymore. Who do we sell it to? Sell it to you. Sell it to you at the other end of this camera. But the tax issue isn't an issue if you set it up in the right company. So if we buy in a limited company and we're going to build a sensible property portfolio, 9 times out of 10, we buy in a limited co. We're going to look at buying 5, 6, 7 properties, make it sort of nice. Buying a limited company, we can be a little bit more tax efficient, and that's better than your name. So we're buying it off the landlord, or the person that's selling it, the vendor that is the landlord, putting it into our limited company. We own the asset. If we buy it at a discount, we add value to it, do it well. We've got a good property portfolio. So we've fixed that problem. Regulation problem, right? So the second one is a regulation problem. The Renters' Right Bill, which has come in recently, that gives a little bit more power to tenants. There's no doubt about that. There's no argument about that. The tenant has certainly got a lot more power when it comes to residential property. But again, it's not all bad. So if you learn to play by the rules and learn to play by the standards that have been set and become a good landlord and create a good product, you'll get good tenants who will pay good rent, and you won't have the issues that are being told. So that is, again, a bit of a non-issue if you get it right. There are a lot of landlords also selling, this is my third reason, because they bought in the wrong structure. They bought in the wrong areas. They almost became accidental landlords, some of them. They bought because it was sort of easy and you couldn't really get it wrong. Then when the rules changed, they had no one to turn to, they had no guidance, they had no support, they had no community. And it's like, well, I might as well sell them, it's easier. But that doesn't have to be your story. And the same in anything. The difference between thriving and struggling is having the right support and guidance around you. So what could we do with your savings and your money that could get you started? Right, so I'm going to take you to my amazing deal analyzer, which I'm super proud of because I now put it in every video, just to show really quickly what a simple deal could do for you. There are 1,000 permutations here, and you could say, well, what else that sign? You haven't bought it at that price, and there's loads of bits you could do. But I just want to show you some basic numbers. And if you bought we bought a good house that we added value to, but in this case, we're just going to sort of buy it in a sort of good area like the edge of Leeds, we can just sort of look at the numbers, basically, or very basic numbers. So say we buy it 150 and it's maybe worth 160 at the end or what have you. We can keep it super simple. And we use it 75% loan to value mortgage. And say the rent was 950. Again, we're all sort of like packety type numbers. I'm just going to put no refurb in for now, make it a little bit cleaner for us. You'd have a gross yield of 7%. And actually for this example, you would need, maybe £40,000 in savings to buy the property and what have you, right? So simple, we've got a little bit of savings, we've bought this property, we've got sort of a good return on investment, good yield, so it's a 7% gross yield. We're making £350 to £400 a month, depending on the interest rate at the time. And then here's where the real sort of good bits and the kicker is. So as we go up in, value, we can remortgage and pull some capital out. But say the property price goes up by 5 to 6% per year, which is a really conservative sort of average, as I think it will be. You hold it for 5 years, you're going to get a good £50,000 capital growth. So that's without doing anything. That's going to just go up in value. You're going to get a nice bit of rental income. It's not life-changing, that amount, and in some areas you can get a little bit more than that. We normally aim for £400 to £500, and over that time you're going to get a total income return of £75,000 on net rent and equity growth over a 5-year period, and that is on a £40,000 investment saving event. Very simple maths, but you've nearly doubled your money in 5 years. You own the asset, you can refinance that, and you can go buy another, and you can do that multiple times. And the spreadsheet gives you a bit of an idea of how to do that. And then that's without us even buying it at a discount and adding value and renovating some bits or sort of increasing value through managing the asset and the tenant. This is on a simple basis, just buying good stock in good areas and knowing how to negotiate that and how to and where to buy that in a good company structure. It is absolutely key. And just to make the point in that video, that net income, that £350 was after your mortgage, was after your letting agent fees, which you might self-manage. In that case, you can increase that by a lot. I've seen one buy-to-let property that someone self-managed, they were making nearly £600 a month profit. And just to make clear as well, that £350 had management agent fees in, your mortgage included. We put money aside for maintenance and voids. So, if you managed it yourself and did a few bits, quite well, you could be making £500-600 on that property without any stress or hassle. So here's the point, right? So the tenant is paying you the rent, your property's going up in value, you're making a little bit of income on the side. It's low maintenance and you don't have to do too much. If you get a good tenant in there, in a good area near good schools, they're going to stay there 3, 4, 5 years, if not longer. You don't have to think about too much. That property price is then going to be worth sort of 200,000, 210,000 by year 5 or 6, we can pull money out, rinse and repeat. Low risk, very simple. It isn't the sexiest, but it is very safe and hassle-free. So what stops people doing this? It isn't the money, because I meet lots of people that have equity in their homes or 20 to 50,000 pounds saved that they don't know what to do with. It's not the market. I'm just showing you all the reasons why the market and the property market is not stopping you invest in property. It's not the intelligence, because most people I speak to are really intelligent individuals, especially if they've got a good job, working hard, and are even watching this video. If you've gone out your way to look at YouTube videos and gather that intelligence, you're not a stupid individual. What stops people is knowing where to start and the fear of making a mistake. There's so much noise on the internet. The beauty of the internet is you can find hopefully really helpful videos like this, but you can also get a lot of noise, and there are a lot of, dare I say it, idiots on the internet trying to sell get-rich-quick schemes, especially in property. But the fear is getting it wrong. Fear is losing money. But the successful people always have that fear, always have that imposter syndrome, I can guarantee it. But the successful people have a roadmap, have some guidance, and know where they're going and don't deviate from it. So here's a little 4-step process that should be super simple that hopefully you can follow. Number 1, get clear on what you can actually spend. What's in your savings account? What's in equity in your property? Have you got a first or second home that you could potentially pull some more money out? Have you got any future inheritance that your parents or your auntie or uncle might want to help you with? What do you have to spend? Where can you invest? What is your budget, if you will? Also, have a little chat to a buy-to-let mortgage broker who can let you know how much you can borrow, get a little offer in principle. Choose where to buy, not just on yield or not on familiarity or locality. Choose an area that has got good capital growth potential, has property that's probably slightly undervalued because it's up and coming and they're on the suburb of somewhere that's very big and going well, and that you know that you're going to get a tenant demand and type because there's lots of work and employment. Don't go to the far reaches of the earth where there's no employment. Get it where somebody wants to live and they want to stay for a period of time. Number 3, understand what a good deal looks like. I don't think many people know what a good deal looks like, despite all the noise on the internet and people saying, look at this, look at that. I have some metrics that are really important to me. 2 and 3 bed terrace properties, freehold. We normally hit a sweet spot of about £150,000 depending on the area. Have we got good rail and motorway networks? Have we got good industry? And then the deal we are looking at, can we get it at a little bit of a discount? Can we add value? Are people going to want to live here for a good amount of time? And I can run the numbers on that spreadsheet and it will show me what a good deal looks like. Number 4, get the right people around you. So important. Get yourself a good mentor, get yourself a good mortgage broker, get yourself a good accountant, and get yourself a good solicitor. These are key when you get to the build phase. Get yourself a good builder. It's a little bit harder and you'll consistently always have to tweak with the builders, but get a good team of professionals around you, get a good support network, and get a good community. Step 5, once you have bought and found the right property, hold it for 20 years. At least, as long as possible. 70% of what you make in property is from holding the asset. Buy and hold that property for as long as you can. Refinance, rinse and repeat, pull out equity, reinvest it within the limited company so you're not paying loads of tax. See one of my previous videos. And build that portfolio. So if you have been sat on savings or equity and you're like, I don't know if it's the right time to start, there's so much noise, it's so scary, why isn't everybody doing it? All these objections I've heard over time, you just need to start. You need to get the right guidance, have the right roadmap, and start. Start small, start basic. Start with simple buy-to-lets. It doesn't have to be sexy. It doesn't have to be driven by your ego. It needs to be driven by low risk and fundamentals that have underpinned the property market for 80 years. If you are ready to start, click on the link below the video. If not, I will see you in the next one.